Building a wealth portfolio with just 4 ETFs. What if you could create a portfolio generating $2,800 monthly in passive income or growing to nearly $1 million by investing less than the cost of a daily lunch? It sounds impossible, but it's achievable. Most investors overcomplicate things by chasing trending stocks, following unreliable online advice, or attempting to time the market, which typically leads to stress and underperformance. What if wealth building could be simpler? What if just 4 ETFs could provide everything needed for long-term growth, passive income, and financial confidence? I call this approach the wealth quadrant system. Once you understand how it functions, you'll see why it's transformative. In this video, I'll guide you through the entire system step by step, showing how 4 ETFs can deliver complete market exposure, portfolio protection during downturns, substantial long-term growth, and over $200,000 annually in passive income. I'll demonstrate how to combine one ETF from each quadrant to build 2 complete strategies, an income portfolio generating over $34,000 in annual dividends, and a growth portfolio potentially reaching nearly $1 million, all from investing just $9 daily. Before examining the 4 specific ETFs, let's understand the underlying system and why this approach can provide the clarity and confidence you've been seeking. The wealth quadrant system. Imagine building a house without blueprints. You might manage a few walls or even a roof, but without proper structure, it won't last. Your investment portfolio works similarly, requiring a solid framework that balances strength, growth, cash flow, and future potential without guesswork. The wealth quadrant system divides investing into 4 essential components: a strong foundation, consistent resilience, high-powered growth, and reliable income. Each serves a distinct purpose, and when working together, they keep your portfolio balanced, stable, and prepared for any market condition. Foundation. You need broad market exposure, covering big companies, small companies, and every sector, not just popular ones. This creates natural balance and risk distribution automatically. Resilience. This layer consists of large, dominant companies that have survived market cycles, crashes, and recoveries. These businesses remain steady during volatility and advance when markets surge. Growth. This is your portfolio's engine, comprising companies investing in innovation, expanding rapidly, and pursuing future opportunities. They're more volatile but offer significant upside potential. Income. This provides cash flow even when markets stagnate. These companies pay you for holding them, and reinvesting that income unleashes compounding power. Why ETFs? To simplify tracking, I'm using ETFs. You might ask, why ETFs instead of individual stocks? The answer is straightforward: instant diversification, instant balance, and elimination of guesswork. ETFs exist that cover entire markets, while others focus on specific sectors like technology or energy. Some emphasize income, others growth. The key is avoiding concentration risk without constant market monitoring. If ETFs are effective, why do many investors feel overwhelmed? Because there's excessive noise. Online, you'll encounter countless conflicting opinions: growth versus value, small cap versus large cap, dividend versus momentum. Every influencer promotes different strategies, leaving you with dozens of open browser tabs, comparing charts and wondering if you've already missed opportunities. That's analysis paralysis, and it's extremely common.
Here's a better approach. Instead of trying to outsmart the market, build a portfolio around 4 proven ETFs. They're diversified, validated, and designed to work synergistically. This way, you stop second-guessing, stop reacting to every headline, and finally achieve what most investors lack: peace of mind and a clear, sustainable plan. With that clarity, you'll also recognize common traps that derail investors, like chasing high dividends or attempting to pick breakthrough stocks. Let's examine why these strategies frequently fail. Common investing mistakes. The dream of living off dividends, getting paid while traveling, relaxing, or simply living sounds wonderful, But most people overestimate income potential and underestimate associated risks. High-yield stocks might display impressive numbers, 6%, 8%, or higher, but usually there's an underlying reason. Perhaps the stock price collapsed, or the business is struggling. If profits decline, that attractive dividend can disappear overnight. Even if it doesn't, a falling stock price can erase your investment value. Then there's stock picking. Everyone wants to discover the next Tesla or Apple before it explodes. But even professionals with full analyst teams and comprehensive data consistently fail to beat the market. For typical investors, it's like throwing darts blindfolded. You might occasionally hit a winner, but you'll miss more often. One bad pick can eliminate gains from 5 good ones. That's why ETFs exist. They let you own winners, avoid total losses, and grow steadily without betting your future on individual stocks. Here's the intelligent part. Each ETF we're about to examine fits perfectly into one wealth quadrant: foundation, resilience, growth, or income. Together, they don't just balance each other, they actually strengthen one another. We're not gambling here, we're building with purpose. Quadrant 1, Foundation, VTI. It begins with the foundation, an ETF providing ownership in thousands of companies across the US economy in one simple move: Vanguard Total Stock Market Index Fund ETF, VTI. This ETF is like purchasing a tiny piece of nearly every American company simultaneously. It holds over 3,600 different stocks, covering everything from tech giants to small-town manufacturers, large players, small caps, every sector. This is your foundation, because it doesn't attempt to predict winners, it owns the entire field. This kind of exposure means you don't worry about which sector is hot or which trend is fading. When tech declines, perhaps healthcare rises. When large caps stall, small caps may accelerate. It's built-in balance, exactly what a solid foundation should provide. At the top, you'll find names dominating the global economy: Apple, 6.19%, Microsoft, 5.17%, Nvidia, 4.66%, Amazon, 3.36%, Meta, 2.34%, Berkshire Hathaway, 1.75%, Alphabet, 1.67%, and Tesla, 1.31%. These are household names with deep economic moats, making up a sizable chunk of VTI's exposure. Beyond that, you're also holding thousands of mid-cap and small-cap companies, the next generation of potential market leaders. That breadth brings built-in balance. When tech cools off, financials or healthcare might lead. When large caps stall, small caps can take over. Through it all, you stay invested across every market turn.
VTI performance numbers. In the past year alone, VTI returned 11.27%, including both price gains and dividends. Its 5-year total return sits at 95.86%. Across 10 years, it has grown by 154.73%, more than tripling an investor's money. All this with an ultra-low expense ratio of just 0.03%, essentially free, meaning more returns stay with you. VTI has a current dividend yield of 1.37%, a dividend growth rate of 6.73%, and an average annual share price appreciation of 9.73%. If you invest $9 daily into this ETF, after 1 year, approximately $3,285 invested. After 10 years, grows to approximately $55,000. After 20 years, reaches $240,000. After 30 years, approximately $600,000. By then, your yearly dividend income would hit $3,100. That's why VTI is your foundation. It's broad, it's boring in the best way, and it's always working steadily over the long run. Quadrant 2, Resilience, VOO. Foundations are essential, but you also want something more focused, something that concentrates on the biggest, strongest companies and provides resilience when markets get volatile. That's where the next quadrant piece comes in, resilience. For resilience, I have Vanguard S&P 500 ETF, VOO. VOO tracks the S&P 500, a collection of America's 500 biggest and most profitable companies. These are firms with solid earnings, dominant market positions, and long histories of driving the economy forward. When you invest in VOO, you're not just betting on the market, you're backing its leaders. VOO gives your portfolio a strength layer. These companies aren't just surviving, they're leading. They've been tested through market crashes, recessions, and rallies. When the economy dips, These are the ones still hiring, innovating, and paying dividends. This stability gives your portfolio resilience, the ability to take hits and keep going. You're not gambling on trends, you're backing giants. VOO Top Holdings. VOO's top holdings are a lineup of giants: Apple 7.03%, Microsoft 5.58%, Nvidia 5.59%, Amazon 3.78%, Meta 2.66%, Berkshire Hathaway 2.06%, Alphabet 1.9%, Broadcom 1.65%, and Tesla 1.53%. Together, these companies comprise over 33% of the ETF, meaning this fund leans heavily into names shaping technology, finance, and the economic future. VOO gives you powerful exposure to technology, healthcare, consumer, and finance sectors without picking individual stocks or timing the market. It's automated, diversified, and ruthlessly efficient. VOO performance numbers. Over the past year, VOO returned 12.19%. Over 5 years, it's up 99.91%. Over 10 years, it is compounded by an impressive 168.52% in price return alone. VOO currently yields 1.36%, distributing about $6.70 per share annually, with a 0.03% expense ratio. It increases dividends by 6.56% annually on average. It has an average annual share price appreciation of 10.32%. If you invest $9 daily into this ETF, after 1 year, $3,285 invested. After 10 years, grows to approximately $56,000. After 20 years, projected to reach $216,000. After 30 years, approximately $659,000. Out of that, more than $530,000 would come from price appreciation, with another $31,000 from reinvested dividends, making $561,000 total value added. By that time, you'd be earning about $2,700 annually purely from owning one ETF. What makes VOO such a powerful complement to VTI is that it sharpens your exposure. Where VTI gives you everything, VOO leans into the winners, and that extra focus can give your portfolio more staying power in tough markets.
Quadrant 3, Growth, IWF. Resilience is just one side of the story. Now that we've established foundation and strength, it's time to accelerate. Let's discuss what drives serious portfolio growth and how the right ETF can supercharge long-term returns. For this, I have iShares Russell 1000 Growth ETF, IWF. This ETF focuses entirely on growth, not slow and steady, but fast-moving, high-conviction innovation. It tracks the Russell 1000 Growth Index, meaning it holds large-cap companies aggressively reinvesting in themselves, building new products, expanding into new markets, and leading the future in tech, healthcare, and beyond. IWF Top Holdings. IWF holds big names like Apple 11.24%, Microsoft 10.6%, Nvidia 9.24%, Amazon 6.42%, Meta 4.03%, Alphabet 3.44%, Broadcom 3.26%, Tesla 3.09%, and Eli Lilly 2.7%. These companies are innovators and disruptors. They're not sitting still. They're driving digital infrastructure, artificial intelligence, cloud computing, and next-gen healthcare. More than half the fund is concentrated in these top 10 companies, so it's definitely more aggressive than VTI or VOO, but intentionally so. IWF is designed to tilt your portfolio toward innovation and future potential. That concentration carries risk, but it's exactly what gives IWF its edge. IWF performance numbers. Over the past 10 years, its price return has been 273.68%, meaning the share price has nearly quadrupled. Over 5 years, the price return is 122.14%. In just the past year, it's up 15.75%. That's not just strong, it's elite performance in the growth ETF space. It doesn't pay much income, the current yield is just 0.48%. But this fund isn't about dividends, it's about scale. It's for people who understand that wealth isn't built from cash flow in early years, it's built from appreciation, then converted to income later. IWF has a current dividend yield of 0.48%, a dividend growth rate of 3.21%, and an average annual share price appreciation of 14.03%. If you invest $9 daily into IWF, after 1 year, $3,285 invested. After 10 years, grows to about $64,000. After 20 years, nearly $350,000. After 30 years, approximately $1.2 million. What's incredible is that almost every dollar of that growth is from capital appreciation, not income. That's the point. IWF adds a forward-leaning, fast-moving layer to your wealth quadrant. It brings scale and ambition, pushing your long-term returns further than stability alone ever could. Quadrant 4, Income, SCHD. IWF is high growth, and high growth often means low income. Not everyone wants to wait decades for their portfolio to start paying them back. That's why the next ETF delivers real, reliable income now, helping you build cash flow you can count on, completing the income quadrant of your portfolio. For this quadrant, I have Schwab US Dividend Equity ETF, SCHD. If there's one ETF in this portfolio that truly earns the label cash flow machine, it's SCHD. While IWF brings speed and VTI brings scale, SCHD delivers steady, rising income with a rock-solid foundation. This ETF is all about one thing: consistent, growing cash flow. Unlike high-yield funds that chase risky payouts, SCHD is built on quality. It only holds companies with strong balance sheets, solid cash flow, and proven histories of rewarding shareholders. These aren't flaky high-yield traps. They're real businesses with staying power. SCHD selection process. What makes SCHD different is its strict selection process. To be eligible, a company must have market capitalization of at least $500 million, minimum average daily trading volume of $2 million, history of paying dividends for at least 10 consecutive years. Once these criteria are met, the fund evaluates companies based on 4 equally weighted factors.
Free cash flow to total debt ratio, return on equity, indicated annual dividend yield, 5-year dividend growth rate. This comprehensive approach ensures that only financially robust companies with strong commitments to returning shareholder value are included. The final portfolio comprises 100 stocks with individual holdings capped at 4 to 5% and sector exposure limited to 25% to maintain diversification. SCHD Top Holdings. Inside the fund, you'll find companies like Coca-Cola, 4.44%, Verizon, 4.41%, ConocoPhillips, 4.3%, Lockheed Martin, 4.28%, Home Depot, 4%, AbbVie, 3.95%, and Amgen, 3.94%. These are firms that have weathered economic cycles and kept rewarding shareholders throughout. SCHD is diversified across sectors with heavy weightings in consumer defensive, energy, healthcare, industrials, and financials. These industries tend to hold up well during economic downturns, which is why SCHD often performs with surprising resilience. SCHD performance numbers. Over the past year, SCHD returned 11.18%. Over 5 years, it's up 58.52%. Over 10 years, it has compounded by an impressive 94.43% in price return alone. SCHD currently yields 4.04%, distributing about $14 per share annually, with a 0.06% expense ratio. It has one of the most solid dividend growth histories, thanks to its strict selection process. Its dividend growth rate stands at a sound 11.3%. From price history, you get an average annual share price appreciation of 6.83%. If you invest $9 daily into SCHD, after 10 years, your portfolio could grow to nearly $58,000. After 20 years, around $291,000. After 30 years, approximately $1.69 million. Since it's a dividend-focused ETF, by the 30-year mark, it will be paying around $200,000 annually in dividends alone. That's over $16,600 per month, all from reinvested cash flow that kept compounding year after year. More than $1.08 million of that total value would come just from reinvesting those dividends, and $588,000 from capital appreciation, adding total value to the portfolio of $1,596,000. SCHD doesn't chase moonshots. It's not trying to double overnight, but it delivers something just as powerful: stability, sustainability, and the kind of income that can give you financial freedom. 2 portfolio strategies. Now you have an ETF for foundation, resilience, growth, and income. But here's the thing. Depending on what stage of life you're in or what kind of investor you are, there's more than one way to use this setup. You can take the same building blocks and shift the weight to match your goals. Some people want their portfolio to start paying them sooner. They're thinking about income, maybe even early retirement. Others are laser-focused on growing their money as fast as possible and letting it compound for the long haul. Let me show you 2 real strategies using these same ETFs. One is all about dividend income, the other leans hard into growth. Both are smart, both are simple, and both are built with purpose. Strategy 1. Dividend-focused portfolio. This portfolio is designed to pay you back with real income when you retire. It's built to generate solid cash flow while still giving you long-term growth. You're not just collecting checks, you're growing your wealth too. Allocation: 70% SCHD, the workhorse, 10% VTI, full market coverage, 10% VOO, large cap stability, 10% IWF, extra growth potential.
To figure out the income this portfolio can actually produce, I looked at the dividend yield of each ETF. SCHD pays around 4%, while VTI is closer to 1.3%, VO about the same, and IWF under 0.5%. Based on how much of the portfolio each one takes up, I calculated the weighted average. Here's how it works. You multiply each ETF's dividend yield by how much of the portfolio it represents. For SCHD, 70% times 4.04% equals 2.828%. For VTI, 10% times 1.37% equals 0.137%. For VO, 10% times 1.36% equals 0.136%. For IWF, 10% times 0.48% equals 0.048%. Add all those up, 2.828 plus 0.137 plus 0.136 plus 0.048 equals 3.15% total dividend yield. I did the same for dividend growth, looking at how quickly each ETF has increased its payouts over the past decade. SCHD has been crushing it with over 11% annual growth. VTI and VO have been solid too, and even IWF contributes, though it's more of a capital appreciation play. When you weigh those based on how much each ETF contributes to the mix, you get a dividend growth rate of about 9.56% per year. Dividend portfolio results. Assuming you invest $9 daily and reinvest all dividends. After 1 year, about $3,285 invested. After 10 years, $57,000. After 20 years, $234,000. After 30 years, $826,000. By that 30th year, this portfolio would be paying you about $34,100 every year. That's over $2,800 a month. If you add it all up, the capital growth plus all the reinvested dividends, you're looking at a total value added of $727,500 over those 3 decades. About $476,500 comes from price appreciation, and the rest, a solid $251,000, is from reinvested income. Strategy 2. Growth-focused portfolio. Let's say you're not looking for income right now. Maybe you've got time on your side and you're in full growth mode. You're not thinking about cash flow yet. You're focused on building a big, powerful portfolio that can give you options later. This one's built for people who aren't worried about income today. Maybe you're in your 20s, 30s, even 40s, and you're thinking long-term. You've got time. You want that snowball to get as big as possible before you start living off it. Allocation: 70% IWF, high growth engine, 10% VTI, piece of everything, 10% VO, balance, 10% SCHD, small income component. Growth portfolio metrics: If you allocate investment this way, the overall portfolio will still have a yield. It's just low, around 1.02%. That makes sense. This portfolio is focused on appreciation, not income. Same goes for dividend growth. Since we're not building around SCHD this time, the average growth rate is lower, about 4.71% per year. It's there, but it's not the priority. Where this strategy really shines is in share price growth. When you look at how fast these ETFs have grown in value, especially IWF, the numbers are seriously impressive. Weighted together, this portfolio's average annual price appreciation is around 12.51% per year. That's where the firepower comes from.
With the same $9 investment, after 1 year, $3,285 invested. After 10 years, around $61,000, already surpassing the dividend portfolio. After 20 years, $264,000. After 30 years, approximately $927,000. That's nearly $1 million portfolio. And remember, that's without chasing high yields or trying to time the market. Just consistent investing, reinvesting everything, and letting the math do its thing. The dividend income from this strategy isn't much. By year 30, you're getting about $794 a year, around $66 a month. But that's the trade-off. You're not collecting big checks today. Looking at the total value added over those 30 years, it's even bigger than the dividend strategy. You're looking at $829,000 in total gains, with $817,000 of that coming purely from price growth. Only about $12,000 came from reinvested dividends. Which strategy is right for you? It's a totally different approach, but the logic is just as sound. The real question becomes, which of these feels more like you? Because neither is better or worse, they're just different tools for different goals. Once you know what you're aiming for, choosing the right one becomes a whole lot easier. Want only dividends? Click the video on screen to see how much you need to invest in SCHD to retire in 30, 20, or 10 years from now.